Hello, everyone, and a very warm welcome to today's major markets update for June the 8th, 2024. I'm showing the slide of our last update because back then we were wondering if we would see five waves up or not, or if we were dealing with a B wave. Given that we've made a new all-time high, it is most likely that we are dealing with those five waves up. We give the market a gold star for its effort to provide us with most likely five waves up. Not really there yet, but it looks pretty darn good. Before I go there, please consider my Secret Service trade alerts. It is similar to the ETFs, but here we track Apple, Google, Microsoft, Tesla, NVIDIA. And as you can see, NVIDIA, we've had some very nice gains. Already bought here late April for the short term, held it through earnings. And as you can see here, we are up 20%. And the biggest thing is that you have stop in place. Whatever happens, you'll get a profit. Intermediate term up 23% since May 17th, which I believe was just a few days before earnings. It gave us a buy signal. And if the earnings would go sour, we had a stop in place. No worries. And look at the long term. We are long since the end of January last year, up 217%. And stops have been raised and will continually be raised till eventually get stopped out. You can say, well, the video is up much, much longer, higher, sorry. But the thing is, most people have no exit strategy in place. And that is the key. I rather take 300% and forego 1,000% if that allows me to hold those 300% and not see 1,000% turn to zero. I just saw a post from a lady that trades at GameStop. She was up $270,000 and ended up with nothing. She went break even. I don't think that's a great trade. Yes, you got stopped out at entry, but to literally piss away $250 million like that, I think it's not good trading, but that's just my personal opinion. And remember, when we do our forecasts, we can never be 100% correct because we are dealing with a complex system which cannot be predicted at all times. It is near impossible. So all we do is anticipate, monitor, and adjust. And when things go sour, we adjust. Always have those stop losses in place, just as we hear, stop, stop, stop. It's all about the stops. If you don't get stopped out, you will lose most of your gains, just as I mentioned. Losing $270,000 in a mere couple of hours is very risky trading. And please remember, many ways for you to use me to your advantage. Please do so. It takes more than one to be able to tackle this very complex system, which is called the stock market. That's why Wall Street hires rocket scientists to do their work, and still they have a hard time beating the market. So let's go straight to the charts. We've covered all the household items. Here is the S&P 500 with the impulse count we are tracking. That is now our preferred wave count. Ideally, we are in this orange wave 4 and orange wave 5, etc. So we don't know yet if we're going to get this, but it starts to look like it because we've made new all-time highs. Okay, then it is most likely a fifth wave, as you can see here. So then we are in the 1-2-1-2 setup, 3-4, 3-4, 5. Ideally, we target 54.27, 54.53, all contingent on holding above our warning levels. The first warning level is, of course, Friday's low. The second warning level will be the breakout we saw earlier this week above 5,300. And then the third warning level is a break below 52.33. Because even if this wave 5 turns into a ending diagonal, so far it's not behaving like one, but if it does, then this gray wave 4 can overlap with the gray wave 1, but not go below this one. So if we go below that one, that is our proverbial first shot that made a hit. If we get the second shot, we'll sink and reach the bottom. So the blue and the gray levels are warning shots across the bow. It means like you better start paying attention. You better start listening to those that have been shooting at you, because the third shot will hit you probably at the stern and you start capsizing, and one more shot will seal the deal and you'll be sinking. And that's what we want to prevent. So once we get down below the second warning levels, maybe taper off a little bit. Don't be a fool. They're old traders and bull traders, but they're no old traders. That's why we put those levels on the charts, and they are just warning levels. Like, uh-oh, start paying attention, and now it's really going sour. This is our alternative, and that we are not going to top for a green wave 5, but actually only a green wave 3, another 4, and another 5. This is very possible, and this is 1-2-1-2 setup. Okay, so this is very possible still. I want to make us cognizant of this fact. If we break below last Friday's low, this wave 4 low here on May 31st, then we should be looking for a 10% correction. If we don't, we hold at around 5,300, somewhere around there, and then make a new all-time high. We're going to go to about 55, 5,600. Okay, so it is still possible. So this is something we are tracking, 1-2-1-2 setup, instead of a larger 1 and a larger 2, or A, B, C, whatever you want to call it. Now, this is the NASDAQ 100. Also, today's low is now the first warning level, etc. You can see them on the charts. Gray is second, orange is third, red is fourth. We've now reached the ideal wave 3 target zone. We should be in this wave 4 and another wave 5. Okay, so this looks pretty good. 1, 2, 3, 4, 5, 6, 7, 8, 9 waves up there. And then we are now in this 10, 11, 12, 13. So that looks pretty darn good to me. We've reached it. This was the standard Fibonacci-based impulse path we penciled in on the charts, and so far it's following it, and we'll see if we can keep following it. We're holding the all-time high so far, maybe a little bit of a retest there for this wave 4. As you can see, it's right there at the all-time high. As you can see, if we take this gray level, see that this wave 4 here, so kind of get a retest of that level, and then the wave 5. Semiconductors, if we zoom in a little bit more, let's go here, there, give it a little bit more zoom, something like this. And we can see we have now confirmed this wave 4. We've made a new all-time high. Okay, so we have confirmed this wave 4, and we're now in this gray wave 5. I still think this is a 1-2-1-2 setup, as I alluded to earlier this week. If we look here at the orange waves, we should now complete this orange wave 3. Okay, so the orange wave 3 should complete somewhere there. And we've completed now blue wave 3, blue wave 4, and then of course we're going to get blue wave 5 of the orange wave 3. Orange wave 4, orange wave 5, contingent on holding, of course, above the warning levels. And this targets somewhere around 5,400, 5,500. Okay, you see this wave 5 here targets very nicely that one as well. There. So this is going to be the preferred path going forward, something like this. There. There, orange wave. Let's make it orange. And then a final there. That would look mighty fine with, of course, always the possibility that we're not going to do it. And that's why we have these warning levels on the charts. So this is the preferred path forward for the semiconductors based on a standard Fibonacci-based impulse pattern. Okay? Dow Jones, I still believe that we are in this C wave of a B2. Doesn't look too great to me. After 5 waves lower, the C wave might not be completely done yet, but this chart doesn't look too strong to me. IWM, neither. We still have not confirmed this red B wave top, but neither have we disproven it. So this still looks like a downtrend to me. We are below the 10, the 20, and now also the 50-day. If we can go below the Ichimoku cloud, I think we can start targeting the 200-day moving average potential, this wave C/3. Okay, so far, IWM is following along quite nicely. It is quite messy here, but the trend is lower right now as IWM fails to recapture its moving averages and fails to move above the warning levels for the bears. These are the bearish warning levels, so to say. Dow Jones should also still be in a corrective bounce before moving lower. The semiconductors, in my humble opinion, isn't done yet. Can we say NVIDIA? If I look at the wave count from NVIDIA, it doesn't look done either. It still has some upside left, in my humble opinion. And that's, of course, why I put up the slide of our great NVIDIA trade. Okay. So moving on to our next one here. No, we're not going to go into market breadth, but we're going to go to the semiconductors there. This is the preferred path once again. So save the changes. Then we had a nice ABC lower for this floor, and it looks to me like a nice impulse higher. NASDAQ 100 as well. Looks pretty good. We should be in this gray wave 4. Potentially we get another 3-4 setup in place, just as I have here for the S&P 500. It's tracking along quite nicely. We count pullbacks now as corrective waves, in this case, fourth waves. So we should see upside, downside, upside. This remains our ideal upside target, continued on holding above these levels. Once this green wave 5 completes, assuming we do complete it, of course, that's why I have a question mark, we have to wonder if we might see a larger pullback and then another rally. If not, and we go below the May 31st low at about 51.90, we should be in a 10% pullback. So that would be about 500-600 points pullback, bringing us back to about the 5,000 level one more time, somewhere around there. And then that would be that black wave 4, black wave 5. Okay. If you have any questions, please let me know. Let's look at market breadth. Continues to deteriorate, less and less stocks participating. As you can see here, since December 2023, now for over more than half a year, less and less stocks participating in this rally. And you can see how long it takes, right? How long it takes before it finally matters. Just as here, it took a whole year, pretty much all of 2021, we saw a deteriorating market breadth before it finally mattered. The other thing is, the longer this lasts, the bigger the next correction will be, because we are setting up bigger and bigger divergences. The same here, so this is for the regular NASDAQ. The regular NASDAQ has the same pattern as the S&P 500. As you can see here, we are dealing with more and more negative divergence on the bullish percent index. So how many individual stocks are still bullish looking? Less and less, only 57%. Compare that to where we were in December 2023. That was about 80%. So we are deteriorating, but so far it still has not mattered. A few stocks can keep this market of stocks higher for longer than most might think. Think NVIDIA, for example, because we're dealing with a market cap weighted average. Okay, and if the market cap of, for example, NVIDIA becomes extremely high, it's very close to that of Apple already, it will have an outsized impact on the index. So all the other stocks might be down. If that one stock is up, the stock market is up. I know it sounds ridiculous. That's why we've been always talking about the Magnificent Seven, and I think it's becoming less and less magnificent, maybe the Magnificent Three right now. But nonetheless, we're still higher, and we'll continue to look higher despite all these divergences. Divergences are only divergences till they're not. They're a condition, not a trigger. If you would trade this divergence and say, okay, I'm going to go short, well, you better have a very long breath, because it's not doing anything yet other than going higher. Another warning sign here of a math rally is the PMO buy all sell all indicator. It is not pointing up, it is kind of pointing down with these intermediate stair steps lower. So this is not looking too healthy either. Okay, the easy part is kind of done. That was here the rally from early May into late May. That was the easy part. And this also suggests a more 4-5 setup. in the wave count. If we're looking at new lows, they're starting to increase. 57 is above the cutoff of 50 for the NYSE, and well into the triple digits for the regular NASDAQ. So this is not a healthy looking market either internally, which matches, of course, with the bullish percent index, not looking too healthy either. But again, the wave count suggests we still have a little bit more upside left before it finally starts to roll over. And then the question is, are we only going to see a 5% pullback, or are we going to see more than a 10% pullback? To be determined, but we're getting close. Looking at the advancing declining issues, also here we start to see negative divergence. Divergence, again, is only divergence till it's not. It has been erased many, many, many times. So we're not going to hang our hat on it. It does show that internally, based on also the other indicators, things are not as great as they look on the outside. Okay. And here then is new highs. Still, since late 2021, we have no cumulative new highs. As you can see here, that was the all-time high here. And every bear market eventually led to, every such divergence led to a bear market, be it 50%, be it 60, 70%. So we're still tracking it. So this is still not a good sign. Again, shows you how long it can last. Back here in the 60s, it lasted 4 years. Currently, we are in about 2.5 to 3 years. Okay, so just to make sure that we are tracking this, because if we do get new highs, it kind of erases the whole idea that we are moving towards a larger bear market, but not there yet. Still not. Okay. Now, what are other people seeing? This is from our friends at wavetrader.net from 3 days ago, publicly available. They're also looking higher, can target as high as 54.47, 55.12. Okay, it is possible. 54, that would make this green wave 5 actually more likely. And also here, if we would zoom in on their 5-minute chart, we're looking for a wave 3, 4, 5 pullback as well. Somewhere again around 5400, somewhere around 5400. So that's what we're looking for as well, kind of aligned. Again, we have our warning levels to tell us we have stopped already. So far, I'm not seeing it. We look at our friend Pretzel, also here looking for higher prices still, well above 53.70. So we haven't really moved above that just yet, just filling in the smaller waves. If we look at ATM snipes, good work as well. This is a post from Friday where he was saying update is coming this weekend. The rally is not over just yet. Don't let basketballers fool you. That's what we are seeing as well, that we are now completing this wave 3 here, and then a 4 and another 5. So we have 1, 2, 1, 2, 3, 4, 3, 4, 5 matches as well. So it seems everybody is aligned with each other. It's not a guarantee. We can all be wrong, of course. We're all wrong to prove right by the market. But so far, so good. I think this wave 3 completed. We're in wave 4 and wave 5. So that's really what we're looking for. Let's do a quick look at seasonality one more time, see what we can find out with that one. We're going to go to the S&P500. We're going to do 96 years of data and give it a little time to think. And here we go. So it looks like we might see a little bit of a local top, June 6, 7, somewhere there, a little bit of a drop here. And then higher prices again, a drop, and then a rally. So this could match this 3, 4, 5. Okay, really good matches. If we then, for example, look at only election years, it also is looking here for a local top somewhere around this week, somewhere around June 7, 8, a drop here, June 9, so might see a little bit more downside on Monday, and then a rally, etc. Okay, so this matches that wave count that we're currently tracking as well, suggesting that the upside is not entirely complete just yet. Again, this is, I would say, the last thing one would rely on for their trading, but we want to see everything aligned, right? And they go, but what about all that negative divergence? Well, we could see quite a steep drop going into, of course, later this month. If we look at the Dow Jones, for example, we could see quite a steep drop. This is 127 years of data, so it's reasonably reliable, but it's just an average. So let it update. You see here as well, top somewhere June 8th. We drop here, then we rally into midweek, and then a quite steep drop into the end of the month, and then a rally. So that could match with what we're seeing here, right? Something like that. And then add this one as well. So we could rally much longer. It's still very possible, but we're not going to hang our hat on it. Absolutely not. As long as it matches, it's great. But we've had many times where after following seasonality, it stopped following seasonality. So we're never 100% certain if this is the path the market is going to take. It's just kind of something like a roadmap, but nothing we're going to hang our hat on. Price is the final arbiter, not seasonality, not market breadth, not MSNBC, nobody's opinion, okay? Only price matters because price is what we're trading. And we must admit, if we look here at the market, we're above the 20-day moving average, above the 50-day moving average, above the 200-day moving average, above the Ichimoku cloud. So it's a 100% bullish chart. Yes, tops always occur, of course, in a 100% bullish setup, and bottoms in a more of a 100% bearish setup, right? But we won't know that until, of course, we start reversing. So as long as we're in a 100% bullish chart setup, we maintain a 100% bullish perspective as well. And in this case, it is the impulse path, and have no reason to believe that that impulse path will not happen. So we've now our first warning level at Friday's low, the second warning level at Wednesday's low, the third warning level at Monday's low, and then, of course, the final warning level at last Friday's low. Very simple. As long as we stay above those, especially the third warning level, the blue and the gray one are the proverbial shots across the bow. Now, start paying attention. But once we get the first hit, we are, of course, in dire straits. That's all I have for this week. Again, we might see short-term a few more pullbacks. Still expect higher prices over the next few days. Let's see how the market reacts once we get close to FOMC, where we are, of course, in this wave count, how quickly it's going to wrap up these waves. But that's all I have for today. As you can see as well, the IWM and the Dow Jones are in a different wave count than the S&P 500, NASDAQ, NASDAQ 100, and the semiconductors. But we treat nothing with one size fits all. We apply the same method, but make sure that that method is not a blanket approach, because that would, of course, be completely wrong. There is no 1, 2, 3, 4, 5 going on here. It's quite a different wave count. Meanwhile, market breadth remains divergent, to be determined when that's going to matter. The longer it lasts, the bigger the ensuing correction will be. And I have no signs that this divergence has been erased. Things are not looking too great under the hood, let's put it like that. So it starts to suggest of a larger pending correction, be it the larger wave 4 or an outright crash. I don't know yet, to be determined. I must say that another 4 and 5 would look quite nice on the charts, but no guarantee. One step at a time. I think we still first need to focus on completing this impulse pattern. Higher, look at the warning levels. Once we start breaking below those, it increases the odds that further upside is not a guarantee. We see similar things as other people, that we still need most likely higher prices before we finally can start to put in potentially a 10% correction, potentially even higher. Take care, trade safe, catch you all next week.